Welcome to another episode of Keeping It Real with Cynthia Lubin. I have a special guest with me today, Mr. Carlos Fraser.
Hey, hi everybody. How you
Hi.
doing?
So, I want you to tell the audience who is Mr. Carlos Fraser.
Very true. My name is Carlos Fraser. I'm a tax accountant. I am a EA. We're based out of Maplewood, New Jersey. The firm Taxco. We have an office in Newark and also another office in Bloomfield. Shameless plug. Our website is www.taxko.co. Where you can find us. I've been doing taxes for about 16 years now. Almost 23 years. I've been doing this since I was 16. I've worked at law firms such as J.H. Cohen. I worked with some non-for-profits in the past. I've worked as a CFO for a non-for-profit in downtown Newark. I worked with Polo Ralph Lauren in the payroll department. I did a lot of tax court cases, helping clients who owe taxes, people who have businesses. We help create businesses, dissolve businesses. If you have tax issues, help you with tax issues. And consulting. I'm not saying I know everything underneath the sun, but I will be able to help people in any way possible when it comes to taxation.
Absolutely. You know a little science.
Little
I always run things by Carlos. I'm like, wait, hold
Yeah,
on.
no.
Somebody asked me a question. I'm like, let me call Carlos.
Put that salt on it.
Absolutely. So you have a variety of experience, as you just mentioned. Um, as this is a real estate show, I want you to talk about, home ownership from, the tax perspective. What are some benefits that someone who owns a home currently or looking to purchase a home in the near future, like what should they know?
Good question.
As far as taxes
Yeah.
are concerned.
I mean, home ownership is like the basis of really good financial planning. I feel that it helps create wealth. A lot of people are very afraid of purchasing a home as it becomes frightful, but we're living in a society where the cost of renting is almost more than the cost of owning. The hardest part is usually the down payment, but with a home, you get double the benefit. In the past, under the Obama tax laws, there was a lot of deductions that you could have taken. With the new Trump tax laws, they're a little bit limited. But what I tell people, buying the house is the cake, and the tax benefits are the icing on top of it. So one example that I use is that, you can live in an apartment for 10 years. It's your apartment. You love it. But if you break your leg, you can't pull out equity in that apartment. If your child needs to go to school, you cannot pull out equity from that apartment. But you can do that with the house. So the house builds equity. And what that means is that if you bought the house for $100,000 and you paid on the mortgage and now it's worth $200,000, you have almost over $100,000 worth of equity that you could pull out of the home. And that's one of the main benefits of home ownership, and it helps you build wealth because everything is really on credit. So if you have the ability to get money on credit and it's secured by your property and you're paying it down, you could then open up a business. You could then invest in other opportunities that are available to you.
Absolutely. One of my last guests, he was talking about the after-tax rate and the additional tax benefits you get from having a home and having a mortgage. Can you go into, what that is and how does it impact homeowners? Like, how does it benefit homeowners? Like the tax advantages.
All right, well, the main tax advantage is if you're a homeowner, you are allowed to deduct your property taxes and your mortgage interest. Your mortgage interest is the interest that you pay on that loan, and your property taxes, of course, is the property taxes that you pay on that property. So let's say hypothetically you're at a 25% tax rate and you have deductions of almost, let's say, $10,000. You get 25 cents on the dollar. So your taxes would go down by about $2,500 in that example. So what happens is you would have a tax rate if you didn't have it, and then you have this after-tax rate, which is lower once you have the property. Now, I mean, those type of examples don't really work that well with the new Trump tax law. And the reason why is that with the new Trump tax law, there are two provisions that kind of holds you back. That first provision is a $10,000 cap on property and state taxes. So that means if you're a W-2 earner and you work in the state of New York, you pay New York $5,000 in state tax, and you have a property that has $10,000 of property taxes, you don't get a benefit of $15,000. You're limited to $10,000.
Whereas before you could.
Before you could, correct. In addition to that, there's a standard deduction that each person gets. If you're single, it's $12,000. If you're married, $24,000. If you're head of household, $18,000. So with that cap of the $10,000 and your mortgage interest, you may not get over that hurdle of the standard deduction. So those benefits that he did speak about, they're still there, but they're harder to obtain with the new Trump tax law. So that's what I was going back saying, you know, the wealth that you really build is the equity in the home. That's the cake. That's what you're going to eat. The icing is the tax. Sometimes you have cake with no icing. It's just
exactly. That's a great analogy. So with that said, how was it for you last tax season? Were you still seeing a lot of homeowners itemizing, because everybody wants to get onto that itemizing
very
schedule?
True. Yeah, last year was horrible.
Oh,
I did not like it at all. I think it was like a shell shock to a lot of individuals, especially if you're a new homeowner, because there are people that come in saying, hey, I just bought a new home, I paid X and Y and Z down, let's get this money back. Exactly. And then I have to let them know, well, you know, you didn't really get over the threshold, especially if they're married. You didn't get over that $24,000 threshold, so unfortunately the property doesn't show up on the return. So it was really a shell shock to a lot of individuals, thinking that they're going to get some benefit from the purchasing of the property, and then I had to go into that cake and icing analogy to kind of cool them down. But it was really hard this year, last year, because it was the new change, and this is going to last till 2026. So it's just the life that we're going to live for, unfortunately.
But it's still beneficial.
As to what do you mean?
Homeownership.
Oh, homeownership is still beneficial. Like I said before, you know, renting is always going up. A one bedroom where I live in Maplewood is almost $1,200 to $1,800.
I would venture to say some homes more.
Exactly, and some homes. So what's happening is people's wages are staying the same, but the cost of living is going up. So if you're not thinking about purchasing something, you're going to kind of meet where X and Y kind of meets together, where your wages cannot really sustain where you're living. You're going to have to move out. There's some form of migration. That's why a lot of individuals are moving to the South. So if you really want to live in the East Coast, West Coast, and those, you know, predominantly areas, look for home ownership. It doesn't have to be the biggest home on the block. It could be a small 2-bedroom, and you can live a really good life that way.
I agree. So a lot of what we're talking about, I just want to clarify, this is more on the residential owner-occupied primary residence. Are there a lot of benefits still as far as investment properties?
Oh, yeah.
So you got excited.
I definitely got excited. I mean, the new Trump tax law is really geared to business owners. It is not geared for the W-2 earner or the person that doesn't have a rental property, because they consider rental property as owning a business. And as a business owner, you basically, as a rental property, you get to deduct everything. Advertising, the cost that you go to Home Depot, the insurance on the property, HOA fees, repairs, maintenance, property taxes, mortgage interest, lawn care. Whereas as a person that has a primary home, is only the taxes and the mortgage interest. So as you can see, there's a laundry list of expenses that you can put on with the rental real estate. In addition to that, that expenses goes against your income. And so you bring in income and you get expenses. And one of my favorite books is Rich Dad, Poor Dad. And he definitely said that an asset is something that's giving you money back. And that's what a rental property basically does. And, you know, we're writing a book about that. And,
yes, we
you know,
are.
we go down that laundry list. I know. So, but you can plug it. You can talk about it.
So what is the name of our book?
It is The Pocket Advisor.
The Pocket Advisor's Guide to Real Estate Investing. Correct. And again, it is focused on the individual that is filing the Schedule C or Schedule E return. So it is either a business or some sort of investment property that you have. And as Carlos named, you know, we go through all the deductions, the advertising, how to take advantage of, you know, the interest expense deductions. I'm trying to think what else. We
did a lot.
We went through a lot.
We did a lot. I mean, basically what we did is that we read through all the IRS regulations. We read through different things. And we took our experiences as you as a CPA and me as the EA for meeting with clients and kind of debunked a lot of myths. And we put it into this one book, and we went down through the laundry list of expenses line by line. So hypothetically, if you're doing your tax return by yourself and you look on the Schedule E, you look at advertising, you can flip to our chapter about advertising, and then we'll give you a list of what things are considered advertising, what is not, do's and don'ts, and certain things to help you benefit more. So, you know, once the book comes out, we feel it will be very beneficial for that new first-time home buyer that's buying that rental real estate, and even for a more seasoned person, because inside the book, we give 2 scenarios. It's like a show of 2 different lives, and, you know, one person is a new buyer and another person is a seasoned buyer, and we just show how it really breaks down. So it's definitely a good book to read. But back to the tax aspect, so the rental real estate gives you so much benefits, but in addition to that, with the new Trump tax law, they have something called opportunity zones.
Okay, yes, talk about it.
Yeah, so opportunity zones.
I thought you were on a QBI, but we could talk about opportunity zones.
Yeah, well, opportunity zones I feel is a little bit better because it's one of the things in the tax law that hasn't really been ironed out. They just recently ironed it out on October 19th, 2019, and what it basically says is if you can purchase a property inside an opportunity zone, which is designated by each individual state. And if you hold on to that property, not buying and flipping, if you hold on to that property for 10 years or more, you pay no taxes. So you can buy the property for $100,000. It can increase to $1.4 billion, and you would not pay any taxes on the gain as long as you hold it for 10 years. There's other provisions. If you hold it for like 5 years, they give you 10% off your capital gain, 7 years, 15% off. But this is a game changer because what's going to happen is you're going to see a lot of investing in urban areas, and those prices of those properties are fairly low. And the good thing is that anyone can create an opportunity zone. It's a checkbox selection on a tax return, meaning that it's just a piece of paper. You don't have to go to the state. You don't have to go to Congress. You just check a box on a return, and you can create your own opportunity zones. And I think that's one of the examples of how home ownership is going to be the boom moving forward.
So for the opportunity zones, does it benefit the small novice investor, or do you have to be a big?
Very good question. Yeah, so that's the good thing about it. You could be a novice investor, you could be a 2-man team or a 1-woman team, and you can create an opportunity zone fund, or like take for example, Prudential has their own opportunity zone funds. So it's really about, you know, knowing how to fill out those tax forms and going to your tax advisor and helping you fill out those forms, and you can do it. There's certain like jumps and hoops that you have to go through. One of the most important hoops is that if you purchase a property and you keep it in an opportunity zone fund, you have to increase the basis of the property by 50% within 2 years. So that means if you buy a property for $100,000, within 2 years you have to bring the value up to $200,000 within 2 years. So the goal is usually to buy low and fix it up. So, you know, foreclosed properties, a fire burn property would be ideal for this, or a vacant property. And that's the main purpose of the goal of the plan, is to go into these urban areas that have vacant or dilapidated properties and bring the value up to them. But that goes back to what I'm saying is like once that happens, rents are going to go up. So if you're renting and you're thinking, oh, I'm renting in an urban area, that's not going to happen. No, they're starting to build up these properties. So in the next 10 years, by 2026, 2027, the rent that you're paying now is no longer going to be the rent because the values of those properties are going to go up. And more than likely, they're going to put some good stuff in those properties, appliances and so on and so forth.
So they want to make sure that, you know, they have a renter that can sustain it for them.
Yeah.
So I mentioned QBI. For me, that was like one of the big changes from the tax. Can you talk about that? Because a lot of people hear about it.
Yeah. QBI is a deduction that they give. So the basic misnomer is that I'll get 20% off of my deductions, in addition to my deductions. And it's not really...
Did we say what QBI was?
Oh, qualified business, QBI, qualified business income, correct. So what they do is they give you the basically the lower of the two, either 20% of the net income from your rental property, So let's say you bring in $5,000 in rents and you have $3,000 in expenses, and that $2,000 they'll either give you 20% of that, or they'll give you 20% of your taxable income. So whatever is the lower. And in most cases, sometimes your taxable income can be like $10 or $20 or $2,000. So you'll get 20% of that. But it's good because what happens is you get an additional deduction that you didn't even have that's put onto the tax return. So it's helpful. It's something that people should definitely look into, especially if they have the rental property. You are qualified for that QBI deduction.
Yeah, I say that to say, like, you know, after you, or, you know, even if it's your primary resident, can you use it on your primary resident, I should say?
Well, yes and no. So if you have a primary residence and you have a home-based business inside your primary residence and you take a deduction for that, you kind of, you know, quasi take the QBI for that, but in all reality, no.
It's for
an investment property. So once again, Trump created this plan for business owners, and business owners in his eyes, of course, is a real estate investor. So anything that's personal is really not going to have any flavor on this Tax Cuts and Jobs Act. It's really for rental real estate owners and people who are creating businesses are that really going to get the main benefit of this tax plan.
Yeah, I wanted to just emphasize that, you know, real estate has so many opportunities.
Correct.
And like you said, especially with our current president, he's really real estate focused. So
Correct.
There's so much opportunity, and there's all these different benefits that, you know, if people are thinking about getting into real estate as an investment property, like there's just so many ways to, you know, make more money. Definitely. And create wealth for yourself. But of course, we are going to have to disclaim, like, this is not specific advice.
Definitely. This is not tax advice. Speak to your tax advisor
Please.
For your own tax issues.
Absolutely. So we are approaching tax season. Like you said, it was a little rough with the change this past year, but I'm sure you're ramping up. Are there any like myths or anything that you would like to dispel?
Yeah, there's a couple of myths.
Okay,
so one of the biggest myths is if I can get all my deductions together, I get a dollar for dollar deduction. So if I have $1,000 worth of expenses, I can take a deduction for that and I'll get $1,000 back. That is one of the biggest myths. So a refund is exactly what it sounds like. It's a refund of your own money. And if you go to Target and you buy a shirt and you bring it back, they'll give you your money back. And it's the same thing with the government. You've been putting money into the government and they give you back. So sometimes if you don't put anything in, you won't get anything out. So there's other exclusions if you have a child and earning credit, but for the most part, that's how it works. But one thing I would tell people is record keeping. That is the foundation for everything. It makes you audit proof, and it helps you really navigate through the tax laws, because when you bring it to your tax advisor, if you give a laundry list of the expenses, they can go through it and say, okay, this is deductible, this is not, and so on and so forth. So record keeping is the best thing I would say.
Awesome. And we talk about that in our book.
Correct.
That is in our intro section. Like, it really is important to have those records. And, you know, you might miss, you're not going to remember everything that happened, but if you're keeping track of, you know, your expenses and your income throughout the year, you know, you can see some benefit.
Yeah, show me the receipts. Show me the receipts.
Show me the receipts.
Definitely.
All right, so thank you for that, your myth, dispelling that myth about taxes. And my last question, I want you to drop some jewels for us. What do you want someone listening to this episode, this show, to walk away about home ownership, especially as it relates to what you see in your world?
I would say the jewel that I would drop is that do not be afraid to go and purchase a home, especially if you're a first-time home buyer. As you know, there's that 3.5% down, so it's really cheap to kind of put the down payment. And in a lot of these counties, especially in New Jersey and over the state, there are first-time home buyer programs where people would give you money to be a first-time home buyer. One of the best programs, I think NACA has a really good program that helps you out too. So purchasing a home is not as daunting as you think. And for some people, you can be qualified for a home with a credit score of 640 and above. So if you can get your credit up, you can save some money, you can really purchase a home. But the thing is, purchase what you can afford.
Absolutely.
You know, I purchased a house when I was younger, when I was 25, and it was more than I could afford. My mortgage was almost $2,500. I downsized. I now live in Maplewood. My mortgage is $900 a month.
Wow.
So downsizing.
Tell us the secret. $900.
The secret was I found the worst house in the best place. I found the worst house in the area that I lived at, and it was selling for like $140,000, and I paid a couple of money down, and it was comfortable for me and the family, and we felt good in it. And the mortgage is so low, we get to save and put the money to other things, and I feel blessed about it. But one thing I would say, I wasn't afraid to just go and jump and do it. And I think that's the biggest thing people are afraid of. I may not have enough money, my credit's not good enough. If it's not, just change it, save up money. We spend a lot of money on things that we don't need, so create a budget, go through your expenses and see what you're paying for, because your down payment in 1 year could be, you know, all the I don't want to say negative living, but the living situation that you're in, if you change your habits and you change your attitude, you could have your down payment ready to go.
Absolutely. Now, I was just thinking, like, are there any tax benefits to renting?
No, there is no tax benefits to renting. Well, if you have a home office, you can take a deduction of the rent on your home office, but that's if you're making income. If you have a loss, that home office deduction is not deductible. I'm not saying renting is bad. What I'm saying is that renting is going to become a dinosaur, and what that means is that it's going to get extinct in a while, because you're going to have to be paying more money than you really have. They just passed a law I think yesterday, that Airbnb can't be in Jersey City. So what's going to happen now is that they're going to move towards where we're at in the Newark area, and then rents are going to go up even more. So there is so many economical factors that can change your rent that you have no control of. But when you have your home, they can raise your taxes, but they can't raise it as much as someone can raise the rent. Exactly. They can't tell you what to do. They can't kick you out. So you have more opportunity to create wealth, build wealth. You could pass it on to your family if you want to. You can't pass your apartment on to your sister.
Yep. I agree. I'm glad somebody else said it, and we didn't even talk about all of this. My friends hear it from me all the time.
It's
so dropping those jewels. You dropped several jewels. Bam.
Jeweler.
But tell everyone how they can reach you.
Very good question. So the website is www.taxcode, which is taxko.co, not com, but co. The office phone number is area code 973-762-7299. Just give us a call, and we can talk to you and help you with any issues that you may have.
Awesome. Thank you so much, my friend, my business partner. All right, we're going to finish this book this year.
The book is
coming
finished.
out. It is finished. We just going to put it out there.
Yes,
That's what I should say. So thank you again, and we'll talk soon. Thank you so much, everyone. Have a great day.
All right, see you later.
Bye.
Bye.